Listen, before we talk charts, reactors, or whatever the next headline is, there's one question that decides whether you make money in a bull market or watch it run away without you. Because markets don't usually rob people with one dramatic crash. They steal quietly. They steal through hesitation, through fear, through that little voice that whispers, just take the win, right before the real move even begins. People keep asking, how do you not waste a bull market? And it sounds simple. Buy early, hold, done. But that's not how it plays out in real life, especially in volatile sectors tied to commodity cycles. The real answer starts with one uncomfortable step. You have to be convinced you're in a bull market. Not hopeful, not maybe, convinced. Because the moment you're not convinced, every pullback feels like the end. Every red week feels like the story changed. And that's exactly how bull markets shake people out before the biggest gains arrive. Here's the part nobody likes to hear. A bull market can be brutal while it's still alive. Months of sideways action. Stocks down 20%, 30%, even 50%. And still, you're inside the same long bull cycle. That's not a contradiction. That's the feature. These cycles stretch out because real buyers don't act like retail traders. Utilities, procurement desks, industrial buyers, they plan years ahead. They contract slowly. And on the supply side, things move even slower. A mine doesn't respond to price the way a meme stock does. You don't flip a switch and double production because the chart looks good. Permitting takes time. Financing takes time. Construction takes time. So when supply is tight and demand is steady or rising, prices can grind higher for years. But the ride is never smooth. It's a staircase with missing steps. Look at the last major run. The commodity bottomed, surged, got smashed, climbed again, and only ended when a major external shock broke the demand equation. That's what kills cycles. Not a scary candle on your screen, which means you can't treat every drawdown like a death sentence. You have to ask the real question. Did the core setup change, or did the market just do what markets always do? Volatility doesn't mean the thesis failed. Often it means the market is trying to transfer your position to someone with stronger hands. That SY, done and T, waste the bull market, mostly comes down to one thing. Don't get shaken out. Most people don't lose money because they bought the wrong thing. They lose money because they couldn't hold the right thing through the ugly part. They see one brutal quarter and convince themselves the entire story was a lie. They watch panic online and mistake noise for truth. And then comes the cruel part. The market turns. Sharp rebound. Another leg higher. And suddenly the same people who sold are chasing higher prices, telling themselves they will get back in on the next dip, while the next dip never gives them the comfort they were waiting for. So here's the rule that saves you. In a real bull market, dips are not invitations to panic. They are tests of conviction. Does that mean you never take profits? No. Taking profits is fine. Nobody goes broke doing that. But there's a massive difference between trimming into euphoria and exiting entirely because volatility scared you. One of the most painful mistakes is selling the whole position too early and then watching the move continue without you. It's not just financial. It messes with your confidence the next time. So what do you do instead? You think in trenches. You build positions in stages. You add on weakness when the setup is intact. You trim in stages when sentiment goes extreme. You don't treat investing like a light switch. You treat it like a dimmer. There are serious investors who manage heat, and there are panic traders who sell green and chase red later. And if you're newer to this, there's a survival checklist that matters more than any hot stock pick. Avoid margin. Avoid leverage that forces you out at the worst moment. Avoid short-dated options that expire before the cycle even gets warm. These are long cycles. The market can stay irrational longer than your option chain can stay alive. Sometimes the best strategy is painfully boring. Own the asset. Wait, let time do the heavy lifting. Now let's talk about something nobody admits out loud. Your emotions don't disappear. You just learn how to use them. Early on, fear screams. Red days feel dangerous. Your brain wants out. But with experience, something strange happens. In the strongest setups, ugly pullbacks start to look like opportunity. You don't force yourself to buy weakness. You want to, because you understand what you own. And here's something that might sound backwards. If you truly believe you're in a multi-year bull market, you almost want pullbacks. Not because you enjoy pain, but because pullbacks are how you size up before the next wave of attention hits. Now, a warning. Not every dip is a gift. Some dips are warnings. That's why you track drivers, not just price, which brings us to a constant reality in mining and resource investing, dilution. A company can be early stage, burning cash, and still be a legitimate long-term story. But it has to survive to win. And survival usually means raising capital. If you buy without checking cash balance and burn rate, you can get blindsided by a financing at a discount. People scream, scam, but often the raise was inevitable. The smart move is anticipation. Look at the cash. Look at quarterly spend. If runway is short and there's no revenue, assume dilution is coming. That doesn't mean don't buy. It means plan entries and don't oversize. Also understand structure. Some financings come with warrants, future rights to buy shares. They help raise money, but they increase the fully diluted share count. That matters. The ugly deals show up when companies are desperate. Big discounts, long warrants, harsh terms. The better operators raise into strength, size it properly, and preserve optionality. Sometimes they use less dilutive tools like converts. The hit isn't always blunt, but discipline shows. So yes, financings matter. They're not automatically bad. The real question is what they're funding and how well the raise is executed. Now zoom out, because this is where the story gets explosive. Over the past year, something has changed. Tech companies aren't just talking about power anymore. They're signing agreements, writing checks, turning nuclear into a strategy, not a headline. Why? Because electricity is becoming the bottleneck of the AI era. And when power becomes the bottleneck, every source of reliable baseload suddenly matters a lot more than it did 5 years ago. That's why we're seeing a clear blueprint emerge. Tech giants locking in power from existing nuclear assets while investing in new builds for the future. On one side, they're securing long-term power purchase agreements and funding upgrades to squeeze more output from plants already online. On the other, they're committing capital to new reactor deployments, sometimes not one giant plant, but smaller units built faster and scaled over time. And when people hear smaller, they assume distant sci-fi. It's not. One advanced developer already has crews on the ground, non-nuclear construction underway right now, concrete, foundations, everything that can move before final licensing is complete. Another is further behind, but far enough along the regulatory path that serious money is willing to attach its name to it. Here's the catch. Some of these designs require specialized fuel, higher enriched material that the industry is only beginning to scale. So the obvious question becomes, what if the fuel isn't ready in time? And that question is exactly why this story matters beyond reactor headlines. Because once construction is real, once momentum exists, fuel procurement starts years in advance. First core loads aren't last-minute purchases. They're planned, contracted, and secured early. That demand can surface long before the public realizes what's happening. And if you're wondering why tech companies are willing to take that risk, look at the alternatives. Gas turbines are booked out for years. Solar is fast, but intermittent. Batteries help, but degrade and need replacement. A reactor that runs for decades looks very different when you're building infrastructure meant to power the next era of computing. Now, layer in geopolitics. Globally, one country is expanding capacity at a pace that makes Western timelines look glacial. That doesn't just create competition, it creates urgency. Urgency changes approval speed, funding priorities, regulatory behavior. Agencies that once moved painfully slow are being pushed to move faster. Shorter timelines, clearer pathways, fewer unknowns. Politics may change the tone, but it doesn't erase the electricity bill. Once projects break ground, momentum builds. Even if pacing shifts, underlying demand doesn't vanish. Is it risk-free? Of course not. Advanced designs still need licensing. Supply chains still need scaling. Fuel availability still matters. But tech companies have learned what happens when you rely on slow partners. When the grid can't deliver fast enough, they don't wait. They build around it. Now address the elephant in the room. Can this raise electricity prices? Yes. Massive load without new supply stresses the grid. That's why targeted investments and long-term agreements matter, to add supply rather than dumping the cost onto ratepayers. Either way, the conclusion is the same. Demand is rising. Supply has to catch up. And this is where it connects back to miners and producers. If nuclear demand expands and utilities contract years ahead, the fuel cycle tightens. If supply lags, price pressure builds. Even without new reactors, many models already show demand exceeding supply based on existing fleets and normal contracting behavior. New builds aren't the whole story. They're the accelerant. And once construction starts, fuel planning starts. And that demand shows up earlier than most expect. Now, here's the twist to watch. If tech companies keep moving deeper, they may not stop at reactors. They may move directly into the fuel cycle. Why? Because if you're funding long-lived power assets, you want security of supply, visibility, optionality. Don't be surprised if tech capital eventually reaches conversion, enrichment, or upstream supply. That would change the game because it introduces a new class of buyer into a market that already moves slowly and reacts late. So if you're asking how to apply all this, here's the framework. Know why you own what you own. Assume volatility is normal. Avoid tools that force timing. Expect dilution in early stage names. Trim into euphoria, but don't abandon the thesis because of noise. Always ask the real question. Did the setup change or did price just move? And I'll leave you with two thoughts. What made you sell too early in the past? Fear, boredom, or outside noise? And if we get a sharp pullback this year, will you panic or will you add? Keep your eyes on the drivers.